I'm just going to introduce a little bit about the history of derivatives as people start to wind in, take their seats, and get comfortable. So, when you really look at derivatives in the big picture, one of the biggest obvious things that every single pitch that a VC gets is the comparison to traditional finance. So when you get a VC derivatives pitch, they basically come to you with the deck and they say, look, in traditional finance, derivatives are like n times larger than any single spot, right? So that's the pitch, right? So then they say crypto derivatives are going to be just as big, right? And therefore we'll all be rich. That's the pitch. So VCs have heard this maybe hundreds of times, and of course it isn't always so. So I just want to introduce the space a little bit better, right? Which is that when you really look at derivatives in traditional finance, one of the places that all the eyes turn to is Chicago. So in Chicago, they actually have CBOE and they have CME and they have all of the traditional commodities derivatives, right? So you have agricultural derivatives. And really, when you get down to the fundamental definition of derivative, it's essentially you're buying a math equation, right? You're buying a math equation that describes a situation, right? So basically, the purpose of derivatives is effectively the concept of hedging, which is that you have a sophisticated understanding of risk and you basically shape the risk, right? So you shape the risk by saying, well, I want to buy this risk, right? So, the concept of spot is super simple, which is I want to buy this asset, right? So that's it. It's super linear, right? But what if you wanted to buy an asset and then you wanted to remove a chunk of that asset? How do you do that, right? You buy math equations, which is derivatives. So basically, that's the history of the thing. And the reason why I took us to Chicago is because there's a lot of weird things people do with agricultural derivatives, like shaving risk based on things like weather patterns, right? What is this? This is called fundamental analysis. Fundamental analysis basically means, what do you really think is going to happen, right? And the problem with crypto derivatives is that there's largely not been any fundamental analysis, right? Which is basically, what do you think about the risk of this crypto? And it's like, I don't know, when, moon, YOLO, like there's no fundamentals, right? It's all speculative, right? So the ability to risk shape and create equations may be limited, right? But the thing that's really interesting is that there may be markets in which there are incredibly big opportunities, right, to shape the risk associated. I think in the history of the crypto derivatives market, the most important derivatives have basically been things like leveraged Bitcoin, right? So things that basically trade on the basis of information asymmetry or perceived information asymmetry, right? Which is basically like people getting rug pulled, right? So essentially, this is kind of the checkered history of crypto derivatives. To me, I think the opening question that I have that is round robin is for each of the speakers to say their name and their organization, and then a little bit about whether they believe in this intro or whether they disagree, and if so, what's your point? So let's start here.
Hi. Hello. I'm Dan Elitzer. I'm one of the founders of Nascent. We are early stage venture investors. We do a lot of pre-seed, stage investments, especially in DeFi. And we are also active users of both DeFi and CeFi venues participating in the markets. I've seen a lot of the same pitches that you've seen. And I would say I like the framing as you're kind of like buying these math equations. I think the thing that is missing here is that I could buy a plane ticket that can take me between like New York and LA, and I could buy that on American Airlines. I could buy it on Spirit Airlines. And the likelihood that I will actually like see the result that I'm expecting is going to be very different. So like you may have different protocols, different projects offering you on the surface the same math equation, but a lot of the nuance comes in like, is that actually going to play out the way that you think it would?
I like the Spirit Airlines thing. That's a big dig against them. Anyhow, please go ahead.
Hi, I'm Joscha. I'm from Wintermute Ventures. I was just asked earlier, Wintermute Ventures. I didn't know Wintermute had a ventures arm, so here we go. Yes, we do have a ventures arm. We're very active, in fact. We have done over 90 investments over the past couple of years. Now, the way I'd like you to think about Wintermute Ventures is clearly, we have the core trading business. We are a segregated entity. And if you interact with us, if we sign a ticket with you guys, it doesn't mean you have to act or interact with our trading desk. Of course you can. And I think this is sort of the alpha that we bring to our portfolio companies. So the way to think about us is we're a strategic venture arm. We'll invest where we think it's strategically relevant for Wintermute to be involved in, or areas of the market that we think we know well and we really can help our portfolio companies out with the sort of the resources that we have, the in-house resources, the ecosystem, and so forth and so on. And towards your very good introduction is I absolutely love that, because clearly we listen to a lot of pitches, especially in the derivative space. It's an area we are interested in. And you always get these numbers thrown at you, and I always say, you know, our upside potential market, TAM is because in the TradFi space is 1 quadrillion, according to the International Bank of Settlements. And you just think to yourself, yo, well, I see where you're coming from. I like your enthusiasm. I like where you think your product might scale, but we're not quite there yet, because derivatives at the end of the day is a definition thing. And there's so many different aspects in the TradFi space that we just haven't built out yet. So you're comparing apples and pears. So yeah, very much resonated with that intro.
Yeah, excellent. Yuki?
Yes, I'm Yuki, and I'm a lead researcher at Fenbushi Capital. So just a little background on Fenbushi. So we are venture capital firms founded back in 2015, and we've been basically investing alongside a lot of the Ethereum projects ever since. And so that's kind of like the background there. And I guess my sort of like a broad sense on the derivative points, I guess mainly two points. One is, as kind of a previous speaker has alluded to, bringing a lot of the TradFi primitives onto on chains. In which case you have a lot of like the UI UX optimizations that every project they're trying to do, including DYDX and now there's Hyperliquid and Paradox and a bunch of like guys trying to offer the best executions with like 5 milliseconds type of latencies. So like the infrastructure piece has been very important for like bringing these type of things on chain. But there's also another aspect, which is to basically provide a very capital efficient but very new primitives as a on-chain derivatives, and those things could include something like, for example, like a Pendle, which in my opinion is quite unique to crypto space, and then in my opinion it's a very interesting types of sort of like derivatives that enabled by crypto, also that is being kind of taking off recently because of the LRT riots as well. So I'm quite excited in general about looking at this space and see like how these two type of different types of broad spectrum of derivatives is going to evolve in the space. And frankly, it's TBD in terms of whether we're going to see this kind of TradFi volumes with this TradFi products on chain, or if you're going to see like more better adoptions on like more crypto native products happening throughout. So looking forward.
Great. Matthias?
Great, nice to meet you all. My name is Matthias. I run a venture firm out of Switzerland. I founded my first venture firm in 2016 and the second one in 2023. We're self-funded, it's prop capital, and we invest in basically Series A onwards. And the reason, and basically, I'm happy to be back in Colorado. I bought my first Bitcoin in 2011 here in Colorado because I wasn't 21 yet. I played college basketball in Colorado, and I was responsible as a team captain to actually buy fake IDs for our entire team so we could go to the bars. So that's actually the reason why I got into the space. First time, and my conviction around derivatives was actually in 2012. I started a real estate investment company in Austria where we just invest in real estate. And at that point, I was like, should I do a variable loan or a fixed loan? And then I thought, what if I could just check on my phone and kind of like move left and right the proportion between variable and fixed and kind of like hedge this market. And that was the first time I really thought about derivatives in detail, even though I studied finance. But in that case, I was like, when Pendle came out, I was like, oh great, that's exactly what they do. Yeah, that's why I'm happy to be here and happy to share some thoughts on our thesis and so on, yeah.
Terrific. Richard?
Yep, so I'm Richard, so I'm from this company called Hailstone Labs. So we're a research lab based in Hong Kong, so we have 30, 40 people in Hong Kong, mostly engineers. So we do a lot of internal research as well as venture building work. So we've built protocols, in the last bull run, that has garnered over $1 billion in TVL. was one of the biggest protocol on AVAX. Obviously, liquidity flowing back to EVM now. So AVAX itself is probably going downhill as well. But yeah, we've built protocols, and more recently, we've been actually doing a lot more primary markets investments. So our thesis and basically the DeFi or derivative space is right now, all these infrastructures are being built, right? Scalability is improving, but still, I think we're still there's still time, and there has to be kind of further scalability need to be built to be able to sort of entertain all these high throughput derivative protocols. So yeah, I mean we've been investing into very innovative DeFi protocols like Panoptic. We love them a lot. We like how protocols are being able to be composable with other protocols instead of building or bootstrapping your own liquidity. You build on top of bigger players and tap into that liquidity, right? So yeah.
Yeah, it's terrific. So, one of the things I really am excited about is Panoptic. Obviously, my firm, Gumi Crypto Capital, we're invested there. And, we really think that this is an exciting infrastructure mechanism. But really, the thing that I'm really looking forward to is the development of killer applications, right? Because really, the applications are the products, right? So this whole mental model of structured products and math equations becomes really, really interesting because when you think about it from a mathematical perspective, you're describing the world and what you think will happen in the world, right? So it's really buying and selling anything that's a description of what you think may happen in the world. And so, I think we heard some really interesting comments about kind of the idea of depends on how you define the word derivatives, right? So that's really a very, I think, valid thing. One of the things that I'm really curious about are what segments or applications in the world of derivatives do people have conviction in, right? Obviously, I have conviction in the casino-style derivative, which is ultra-leveraged Bitcoin, right? And what we see that people buy spot, right? And then in each wave, like subsequent degens get more and more leverage, right? And the weird thing that happens is that you see this big buildup of people taking lots of leverage, and then all of a sudden, like Bitcoin turns and they all get wrecked and they're gone. Like those users never come back. Like they're fully destroyed, right? So the thing that's kind of interesting is that's certainly a phenomenon that we've observed that's real. I would say that one of the areas I'm excited about is actually credit derivatives, right? And I feel like credit derivatives, especially when you kind of look at, we have on-chain fully collateralized, right? But really there's a lot of potential capital efficiency that can be had understanding and shaping the risk curves and mathematics, understanding the underlying creditworthiness of an asset. And I think that's really, I don't know, one thing I'd like to do is, so I just wanted to say the things that I have some conviction in terms of, the last category I'd like to assert conviction in is something that I would call crypto-native derivatives. So crypto-native derivatives are really kind of like almost, obviously you could say there's like leverage speculation, but like you could see the emergence of things like right now, like one of the other day, some utterly degenerate person told me that they wanted to create a secondary market that produces liquidity for points, right? Which is like super degenerate and kind of insane, but like it definitely feels like the third category is crypto-native derivatives, which are things that don't exist in traditional finance at all, right? So that's another category that I think might be interesting. But one of the things that Dan said kind of caught my interest, which is before we kind of launch into this kind of idea of which categories do you believe in, right? I just wanted to get your comment on Spirit Airlines, right? Because obviously we can all buy math equations, right? But you were talking about the difference between sort of promise and delivery. So I'm really curious, like if you could kind of unpack that for us a little bit further on kind of what was your motivation in sharing that with us?
Yeah, I think there's a lot of advantages to blockchains in terms of removing the need to trust certain counterparties in certain ways, but you're inherently taking on like additional smart contract risk, and in some things you're taking on oracle risk, and sometimes there's like just like unknown tail risk around liquidity of different things. And so you may have the same math equation on the face for your instruments, but if you're entering a trade, you can't just look at the kind of like on the tin math equation. There's often a lot of other ways that you can get screwed, even if you're right on the bet that you think you're making.
This I love, and I think that that's a very powerful kind of like seismic message. And one of the forms of derivatives that I also believe in, but is not actually a real derivative, is insurance, right? So like when you think about how do you define the word derivative, right? There are products that are derivative products that may act in the form of insurance that may not have kind of like a mutual, like that are backed by that kind of structure. So I guess I just want to throw it out now to the panel, which is I do want to just throw out the question, whoever wants to grab onto it, which is, what is a segment of derivative that you do believe in the growth of? You know, either one that hasn't been previously mentioned, or alternatively, you could say one that's been mentioned that you're like, I don't believe that. So, you know, what are the categories that you guys want to add or subtract?
Yeah, actually, as I kind of referred previously, I think what Miko mentioned about the crypto native derivative is something that I'm personally more interested in. Like we have seen a lot of like perp DEX experiments across the space, and now we have, you know, newer perps and sort of like seeing like a bit of a generational transitions from like, you know, back in the day we had DRDX, now DRDX has gone to Cosmos, and we have Hyperliquid and Paradex, and coming out the new generation perp DEXs, who are also taking a lot of volume because of like farmings and points or whatever. It's just like this kind of cycle is going through. And something that I was kind of feeling like things to me didn't really stick in that perp DEX cycle. And which is why it kind of made me wonder, like, perhaps we are missing something in this derivative space, which is around like, okay, maybe we should just like build a more composable but crypto native derivative that leverages on existing liquidity, that use the liquidity as a moat for the product, instead of let's say the pumping the wash trading volumes for the product. So that's why like I'm looking at, for example, something like tokenizing yield, or as Miko mentioned, tokenizing the points are. It's risky, but it's a very interesting ways in which people are trying to experiment with this, inherently degenerate culture that we have, and I'm very much looking forward to see more of that kind of experiments to be made on chain. Yeah.
Yeah. So there's. I'll jump in there real quick. I think this is very interesting, and I think clearly we have the advantage in the DeFi space. Loads of smart people coming together, looking at a system which in some places has worked very well, but other places it hasn't. And we come up with derivatives to try to solve for that new technology that we're building on top of, right? So perps is actually a good example because the perp has been around since the 90s. I don't think it was properly utilized, is my understanding, correct me if I'm wrong, outside of Hong Kong in the commodity space back in the time, and then someone in the space came up with it, and now this is sort of the go-to futures market. The other way to think about it is, let's take the option space, for example. Very smart people, some of them are in the room, came up with an idea to build on top of AMMs, have options protocols on top of that, right? This is one way we could solve for this. The other way is we look at what's happening in sort of at the crossing between the TradFi and the DeFi space, the digital asset space. You look what's happening with spot ETFs, being issued. Initially, I was always very, I wasn't very excited about it, to be honest, because it's quite a boring topic. We've talked about it for ages. Now that's coming in, we've seen a lot of inflow. And what I think the result of this, what will happen, is essentially that we'll see a lot more institutional clients getting more comfortable with the digital asset space. Specifically, we have spot Bitcoin ETFs now. Now, the next thing, if you ever looked at an ETF market, you have inverse ETFs, you've got leverage ETFs, you've got covered call ETFs, all of that stuff will happen, right? So if you look at covered calls, this is a covered call, so you're essentially selling out of the money call options, right? So someone will have to buy call options in order to do that. Inverse ETFs is essentially the same thing. You need futures, or you need options. Leverage ETFs, you need options for that. So we'll see a lot more institutional demand for options, and as a result of that, I think we'll see market makers who tap into the CME and can use that volume in order to bridge it into the DeFi space. So I think the demand that's happening on the institutional side might actually drive the demand in the DeFi space for a product that's been around for ages, which people are comfortable with. So I think, I'm not saying stop building on other solutions, but I'm saying with time, with institutionals coming in, they're comfortable with these products, we will see the volume. And yeah, so this is, I suppose, a derivative.
Yuki.
Yeah, I have a quick question.
Fire away.
So you kind of like mentioned that institutional adoptions will be coming through inverse ETF and leverage ETF. What I guess I'm not seeing quite here is like how does that translate into the DeFi side? Can I also argue that, well, wouldn't it just feed into the CeFi side of the business and then perhaps even just like stop there?
You could absolutely argue that. The point I was trying to make is you go with your market maker, right? You see the opportunity to buy an option with a certain expiry, whatever the profile is, on the CME. And by the way, we are a bit away from this, but you do this. Then at the same time, you see whether you can delta neutral hedge that position and arb that position out in the DeFi space if you see the same profile trading in the DeFi space. Now, again, we're a bit away from that because the problem with options in DeFi space has been, of course, that the DeFi space is very fragmented. Options in itself, traditional futures, that's why we have perps, is, you have expiries, so you have different kind of profiles and they fragment them more. But I'm saying is, as there's more demand, there's more options buying and selling in the traditional markets, I think there will be smart guys who figure out how to cross it over in DeFi, and that flywheel effect will perpetuate the market. Feel free to disagree, I think that's what we are.
Can I disagree?
Oh, that's the best thing,
yes.
Please.
Because like one thing that I'm often, because okay, this is examples that we already seen here. You're probably familiar. Actually, I'm not sure if everyone is familiar. Like someone like Sorella Labs, right? There are already this kind of a 6x arbitrage that is happening via AMM, and LPs are losing money, and so there's like people trying to build solutions to help them bridge the gaps. But something that we have to also realize is that this kind of so-called LVR, loss versus rebalancing, the profit that LPs should have been making that they are not making, which is essentially what LVR is. This happens because we have already achieved a significant amount of liquidity and, I guess, product market fit, sort of, with AMM model that we have today. So in order for me to really be convinced that, okay, well, we're going to have this like a hybrid model where Wintermute is going to be acting as the bridges sort of like arbitrages between the DeFi market and the CeFi market. My assumption was that, well, we first have to have the DeFi market adoptions. Otherwise, there's not enough volumes nor arbitrage value to be captured. It's going to be either one, too much slippage, and two, you need to hold an inventory risk, and third, you're going to have just the infrastructure cost of like bridging or just performing on-chain actions, which cost gases as well. Which is the reason why I was kind of like not sure if that.
But I just really want to be quick on something. I don't speak on behalf of Wintermute, right? So this is Wintermute trading.
That's right.
Wintermute trading, so just be absolutely clear.
That's right.
In my opinion, there's market makers who will figure that out, but appreciate it anyway.
Yeah,
Matthias?
I think if I can take a complete different angle, I think there's much greater problems than what we've discussed here, which is, I think, user interface, usability, and so on. And we're looking at DeFi derivatives from a infrastructure perspective. And if you look at that, then, for example, we came across, and by user interface, I don't mean a website or anything if this is green or blue or black. I rather mean we came across this company recently that does intent-based derivatives. And basically what they do, they're natively cross-chain. And so what they are building at the moment is very ambitious. But they're building, basically, you have a Sol wallet and you have an EVM wallet. And let's say you have a margin call on your Sol wallet, and it automatically from your EVM wallet tops up the Sol wallet like this. So that's just one use case. Another use case is every time you have more than 30, 40, 50 ETH in your wallet, it automatically whips up a pair, like a pool, and you generate some sort of yield for that. So these are just tiny examples, but imagine what you can build on top. This is a low-code, no-code solution, drag and drop for everyone. And so I think that in terms of usability for building and in terms of usability for the end user, could catapult DeFi derivatives into a complete new segment, which I haven't seen yet so far.
I mean, it's definitely an interesting construct because what we've seen in traditional finance is that the vast majority of the volume of derivatives is really driven by a fairly small number of fairly elite algorithmic traders that sit in kind of proprietary or they sit inside of hedge funds, So I really feel like that's a pretty elite and small group, and that in a way this kind of flavor of democratizing derivatives feels scary to me at some level, right? Because in a way, because there are, so that there's effectively risk reward amplification derivatives, right? So the speed at which people can get fully wrecked is sort of unprecedentedly fast, right? And obviously, when you think about the emergence, I think one of the gaps that's really interesting as we see the emergence of so-called on-chain real-world assets, or RWA, is that we actually have this blockchain technology that sort of swallows all of traditional finance, right? So in that scenario, you will see basically traditional finance scale, derivatives sitting on top of RWAs, because you're really just talking about things like agricultural commodity on chain or whatever, right? But to me, the thing that I think is really interesting kind of comes all the way back to what Dan interjected a little bit, right? Which is ultimately what people buy and sell is like the future. I mean, it isn't necessarily like futures, but it's really the idea of there's a mathematical description of risk and you basically buy and sell what you think is going to happen, right? But the thing that's really interesting comes back to things like tail risk, or it comes back to things like kind of this full far end tail risk stuff that pops up in crypto, right? But I guess to me, the topic that I want to unpack is, a so-called RWA, right? Which is what does that do to the world of derivatives and the potential? Maybe Dan.
I'm really not bullish on RWAs in the next couple of years. I think treasuries on chain, nice, fun. Eventually, will all assets and markets be on chain? Yes. Do I think that's this cycle? No.
That's interesting. I mean, when confronted with our real world assets, oftentimes my retort is, I prefer fake world assets. And then if they ask me what that is, I'm like, Bitcoin.
I'm here for crypto. I'm not here, I can buy stocks. I'm not interested in doing that on chain. On the Ondo thing today was kind of interesting. I think they're taking an interesting approach. But I will say that, to your point about what have we seen in derivatives, what have people been excited about? It's been large leverage, right? People I'm pretty sure nobody in here is bearish on crypto over most time frames, right? And so there's always this demand to go long with reasonable or unreasonable amounts of leverage. And one of the interesting products that we've seen emerge from this, I think recently, has been Athena with USDE, this idea of tokenizing a carry trade. And so I think the idea that we can create some interesting derivatives within the crypto ecosystem, I think there's a lot more product market fit in the near term for crypto native, kind of crypto referential derivative assets than there is from bringing real world assets on chain.
Yuki.
So Athena is technically a derivative product, right?
Yeah.
Right.
I mean, that is how I would think about it. Yeah.
Right. Well, that was a bit of a trick question because I was meant to say that. Well, that means is this actually stable if it is that derivative? But I think there was a very interesting conversation I had with other researchers, specifically on Athena's, which is that because in nature Athena is a derivative product, and that there's always some tail risk that is associated with it.
Oh, absolutely.
Yeah. But in the grand scheme of things, that tail risk may not be significant. But if you start adding things like leverage on top of what Athena provides, basically you leverage on Athena, then the Athena's tail risk could actually expand with the leverage that you put on top of it, which actually could bring this whole system to quite a fragile state, because now you're amplifying the risk from what it was like a tail, now it's actually quite significant.
Yeah, I mean, we saw that actually in the traditional finance world with effectively Lehman and the emergence of CDO squared, which is sort of the credit default swap, right? So the kind of fragility gets amplified by effectively the ability to multiply risk, right? So you really increase, and obviously like entire houses and prop houses are built on top of these extreme cases, and they're built really quickly, right? So in a sense, it becomes an accelerator to the market cycle, you know. So it's a really, really interesting framing, and one that I think we'll see quite a lot of. Yeah, so, you know, I think we're kind of winding down. You know, if anyone has any kind of like capstone to place on this or any retort on anything they've heard, it sounds like Matthias may have some.
Maybe not on RWA, but I have to say I'm also not bullish on RWA. We were part of tokenizing the first bank in Switzerland in 2018. We tokenized real estate, IP, everything. There's simply no liquidity out there. Please, someone tell me if there's a security token exchange that has a reasonable liquidity. I mean, the topic, it's just fun. We're just going back to 2017 and talking about, now it's called RWA. I'm sorry, I'm really not bullish on that at all. One thing that really I think is, I'm very interested in is scalability of technology infrastructure. I think before we talk about derivatives, let's talk about DEXs. What is the problem about DEXs today? The technology is static, it's 3 years old, you cannot upgrade it. If you upgrade it, you need a full migration and you'll lose all your client base. That's a huge problem. So we need to focus on building technology that is actually scalable and upgradable without having regulatory scrutiny there. And in that regard, we came across this company that takes concentrated liquidity, UniV3, and they actually segregate the core layer of an AMM where the liquidity is stored, and they add a plugin layer. Not like hooks, but similar. They add a plugin layer. And the plugin layer, randomly I thought, is a perpetual, for example. So you have the core layer that just makes sure your DEX runs, and the perpetual you can just put on top, and there goes your perpetual. Now you're asking yourself, okay, what value does this have? Against UniV3, gas fee efficiency, 70%. For example. So they have really a gas fee reduction of 70% of UniV3, 30% against UniV4. Because for the first time you can have customizable pools, you can have limit orders, you can have TWAP, you can have all of this on top of your pools. And that's going to be interesting for the regulator, because the regulator will say sometimes, no, I want KYC on this pool, or I want a certain documentation or something like this on that pool. That's exactly what they're doing. UniV4 is trying something like this. The problem with UniV4 is they have a singleton approach, so one pool carries all the liquidity. There we have compromise risk. There again, we're going into risk management, which in my opinion is the biggest topic around DeFi derivatives, which we can talk about later. But upgradability of technology that allows DEXs to be upgradable without losing and creating another layer of fragmentation, either in form of liquidity or just a separation of user base, that will be key. Once we can manage this, then DeFi derivatives, you can build like proper, complex solutions on top of these infrastructure. So that's something I think not very much talked about, but that's going to be a big topic in my opinion.
Yeah,
I strongly disagree with building.
I thought so too, yes.
I want to hear that,
I was
please.
like,
Please do.
Yeah, I don't think you want to be building on top of upgrade. It's a massive attack surface. So I think the right way, I do agree with like building on top, building layers, but I think you want to start with unupgradable layers and then do upgradable layers closer to the user above them, then that can manage moving across.
Yeah, the core layer is not
primitives.
upgradable. The core layer remains. They're always the same. What's upgradable is the perpetual you're building on top, or the TWAP, or the dynamic fee sharing, or the volatility-based pricing. That is upgradable and changeable. Obviously, the core layer is audited and you can't touch it at all. Yeah.
Okay, I'm cool with that.
I don't know. I find in the DeFi space, immutability is more of a feature, not a bug. So let's say even if you have this perp on top of the base layer, I don't know, like some base contract on Uni or whatever. I think it's a feature that it's immutable. And frankly, I don't find it like if it's like built well enough and it's like battle tested, runs well, immutability should be the end goal of those products eventually. So yeah, I personally don't really see a value in being updatable contract for those DeFi products.
All right. Well, I think that we do have a time limit, so we do have to close it there. But I definitely think you've heard from the bleeding edge of thought around this venture capital interaction with DeFi derivatives. So super happy to have these panelists. Hopefully a big round of applause for all these guys.
Thanks for hosting us.